Hello, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors First Quarter 2018 Performance Update. I will be providing a brief first quarter performance overview of all the iSector models and discuss one way to become an elite advisor. Both iSectors post-DPT allocations fell behind their benchmarks in the fourth quarter. These strategies were helped by their technology stock allocations. Treasury bonds, utilities, and energy stocks lagged the market. As presented in the chart on slide 3, post-DPT growth, which has an S&P 500 benchmark, has moved from stocks not sensitive to interest rate movements to bonds. The rule-based model behind the strategy indicates that 10-year treasuries at around 3% yields have better valuation than equities, given the data being released. The amount of leveraged ETF exposure remains unchanged from 6 months ago at 21%. But there is less financial stock exposure and more of utilities. Post-DPT moderate is even more conservative, with greater allocations of treasury bonds, financials, and utilities. The iSectors post-DPT allocations continue to outpace other ETF strategies. We are pleased that moderate was ranked 5th among all 54 global balanced allocation ETF strategies during 2017 in the Morningstar ETF Managed Portfolio database. The equity allocations turned in mixed results for the quarter. Although the iSectors global equity allocation outperformed the iSectors domestic equity allocation, they both fell behind Standard & Poor's 500. Global equity matched the MSCI All-Country World Index in the quarter. Global equity has been the best performing iSectors allocation over the past year. While domestic allocations benefited from growth stock holdings, emerging market funds helped global equity. The iSectors domestic equity allocation has earned very attractive returns over the past five years compared to most U.S. equity strategies. In fact, the domestic equity allocation is ranked 18th of all 641 ETF strategies in the Morningstar database for 5-year performance, even though it has been underweighted the high-flying growth stocks. The pairing of iSectors post-DPT growth and domestic or global equity has been a very powerful combination historically. The iSectors domestic fixed income allocation surged ahead of the Barclays aggregate due to its strong positioning in high-yield securities, whose interest payments offsetted the rising interest rates. The iSectors global fixed income allocation was helped by international weightings, such as the iShares Global ex-US High Yield Corporate Bond Fund, HYXU, in the quarter, as presented in the chart on slide 5. The allocation was also hurt by mortgage-backed fund holdings, such as the Vanguard Mortgage-Backed Securities ETF, VMBS, that was negatively affected by heightened interest rate volatility. As you know, both stocks and bonds declined in the first quarter, which has continued thus far during the second quarter. But the iSectors inflation protection allocation was flat and helped protect portfolios utilizing the strategy from larger declines. Gold securities had positive returns, while real estate fund results were negative. Your clients need a diversification of the inflation protection strategy. Even though gold performed well, as indicated by the graph on slide 6, showing the movement of the Sprott Physical Gold Trust, PHYS, the iSectors precious metals allocation was negatively affected by its palladium holdings, holding ETFS physical palladium shares, PALL, which would be affected if trade sanctions are enacted. Both the iSectors endowment and iSectors liquid alternative allocations beat their benchmarks in the first quarter. As indicated by the black line representing the PowerShares MSCI Global Timber ETF, CUT, commodity funds were strong relative performers in both allocations. Energy and other infrastructure funds, such as the Global X MLP ETF, MLPA, hurt the results of both strategies. Both allocations are broadly diversified and aim to reduce total risk in client portfolios. Endowment is the most diversified iSectors allocation and can be a one-stop solution for client portfolios. Also, the liquid alternatives allocation has outperformed hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.3%, liquid alternatives will provide attractive risk-return characteristics as equity returns ease. Tactical Global Balance allocation was the best performing iSector strategy in the first quarter due to its positive return. Emerging market equities, as graphed on the chart on slide 8, using the price movement of the Vanguard MSCI Emerging Market Fund, VWO, enhanced returns in addition to broad commodity market holdings. Although this strategy can go to all cash, it earned this attractive return by remaining fully invested in all global asset classes except for bonds and real estate. The chart on slide 9 indicates that the iSectors capital preservation allocation has earned over 2.5% on an annualized basis over its 8-year life during a time of low interest rates. The yield is attractive with a short duration while maintaining investment grade quality on average. Capital preservation rose during the quarter due to short bond holdings. iSectors is committed to helping you create the strongest advisory business possible. The data shows that elite advisors spend proportionally greater time on client servicing and employee training and less time on investments and administration than the average advisor. Many of you have already taken this lesson to heart and are using only third-party managers to run the investments in client portfolios. If you have not, please consider this chart as you plan your activities for the balance of the year. Although iSectors offers 16 distinct allocations to serve your clients' needs, we do not expect any advisor to utilize all 16 strategies in their practice. In fact, we recommend that you create what we call a common allocation that can be applied to the vast majority of your client portfolios. The percentage allocations of the strategies will be individualized in each circumstance, and allied allocations will be utilized, but your goal is to implement mass customization in the investment process. Besides reducing your time to monitor many different strategies, utilizing common portfolios reduce your client meeting prep time since you will be more knowledgeable about the client's holdings. Historically, this could be implemented with a single stock bond balanced fund or strategy. The chart on slide 11 utilizes some Thomson Reuters data to show that all the traditional markets, including stocks, bonds, and residential real estate, are overvalued at current levels. The only other time this has happened over the last 35 years was before the 2007 to 2009 financial crisis. Clearly, client portfolios need diversification from traditional asset classes. We suggest that most clients can receive efficient diversification with a combination of 2 of our allocations. The base will be a multi-asset allocation of many traditional asset classes, such as post-MPT growth or moderate, depending on a client's risk posture. The advantage of using one of the post-MPT allocations is the objective of minimizing downside risk. The chart on the left side of this page shows the percentage of rolling 4-year periods where the S&P 500 earned negative returns, and the same for post-MPT growth, as the S&P 500 in red and post-MPT growth in blue. And post-MPT growth, as you know, is our most aggressive strategy. Since its inception since 2005, thus, this time frame includes the 2007-2009 market decline. As you can see, the S&P 500 has had negative 4-year periods almost 30% of the time, while post-MPT growth has had negative returns less than 1% of the time. Next, we recommend that you add an alternative strategy, such as the inflation protection or liquid alternatives allocation. Inflation protection was our most positive strategy during the March market decline. The chart on the right presents the market's expected 10-year inflation rate calculated by the yield difference between 10-year treasuries and 10-year treasury inflation protection debt securities, or TIPS. As you can see, the market is expecting the highest levels of future inflation since 2014. Given the relative cheapness of the TIPS and commodity funds in the inflation protection allocation, it is a particularly attractive strategy to consider. Scott Jones and I are willing to discuss the details behind this allocation and proper ways to allocate between the two strategies with you individually. I wish to conclude by thanking everyone for attending our webinar today. If there's anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We could be reached directly at 800-869-5184. Again, thank you, and we hope you have a fabulous summer.